Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session we are going to start with a very new series, and this series is on behavioral finance. Friends, in the first half we are going to talk on foundations of behavioral finance, whereas in the second half we are going to discuss on behavioral finance theory. Friends, for discussion on topic we have with us in our studios the subject expert. Our subject expert is Dr. Divya Verma Gakkar, and she is assistant professor in School of Management Studies, Guru Gobind Singh IP University. Dr. Gakkar has immense experience and we believe that you are going to get in-depth knowledge through her. So friends, once again we would like to welcome our guest Dr. Divya Verma Gakkar. Through her we are going to get in-depth knowledge on the entire series that is behavioral finance. Friends, we know that you might have lots of questions regarding the series as well as regarding today's lecture too. For this, you have a facility to talk to us, to talk to our expert. Friends, for talking to us, you need to call us through our toll-free number. Our number is 1800-110-430. I repeat, our number is 1800-110-430. You are requested to call in the last 10 minutes of the lecture only, so that first you could have a deep, vicious session with Dr. Divya Verma Gakkar. So, let's welcome our guest, Dr. Verma. Hello ma'am, welcome to the lecture.
Thank you so much for inviting me here. Today's topic is behavioral finance. This subject is upcoming in the area of finance. This topic is going to benefit those students who are studying commerce, who have taken commerce as a specialization, let's say in class 11th, 12th in their graduation, and who want to pursue a career in the area of finance. Those who are interested in investing in stock market, for them also this lecture series is going to be very, very useful. Behavioral finance is a subject which has grown up as a research field in last 20 years. In 1972, Daniel Kahneman gave a theory on prospect theory which defined, or which was the foundation of behavioral finance since 1972. Since then, lot of research has taken place in this subject area in foreign countries across the world. In India, the subject is new. At lot of places at the graduation level, at BCom, BBA level, and at the post-graduation level with various PGDM and MBA institute, this subject has been recently introduced. So, I would like to cover up this subject in various topics. So, today I will first discuss about the foundations of behavioral finance. So, anybody who has some interest in investment in the stock market can understand and can feel that this subject is going to be very, very important for them, because it is the whole of finance. It has been understood that the whole of finance is being managed by human beings. So, understanding their behavior is very important. So, how do you invest your money? Your money is being invested by yourself, by your family members, or by your investment consultant, who all are humans. So, there is a requirement that understanding of human behavior and psychology and other aspects of decision making has to be considered. So, this is one subject which throws light on what goes in the mind of an investor, what goes in the mind of a person before at the time he is investing his money. So, that is what we are going to discuss about finance. Finance as a whole, all of us understand, is a very dry subject. We are dealing with numbers all the day, and we are looking at the financial statements, at the balance sheet, profit and loss account, and then talking about taking financial decisions related to companies. But over years it was felt that it lacks some human characteristics. So, those human characteristics, because the decision makers like CEOs, CFOs, all the managing directors, so all of them are human beings. They are affected by various biases, they are affected by their behavior, they are affected by their personality, their attitude towards life, towards taking decisions. So, all of these things also affect the corporate decision making behavior of these managers and the top management who is sitting in the big companies. So, what kind of behavioral factors that can affect their decision making in taking financing decision, investment decision and dividend decision is what we are going to discuss in this subject. So, talking about the importance of behavioral finance, Dr. Mayer's statement provides one of the best explanation that why this world needs behavioral finance. He says, people in standard finance are rational. They are not confused by frames. They are not affected by cognitive errors. They do not know the pain of regret, and they have no lapses of self-control. People in behavioral finance may not always be rational, but they are always normal. Normal people are often confused by frames and affected by cognitive errors, and know the pain of regret and difficulty of self-control. So this definition is so comprehensive, it explains a lot of things about human decision making characteristics or human behavior. Now, over decades, over almost 100-200 years, we have seen finance the classical finance as or also known as standard finance in a very different frame. There have been theories in accountancy. We deal with profit and loss account, balance sheet, statements and other schedules which are being designed. Apart from that, there are financial management theories, like there is capital structure theories given by various researchers and authors. There are dividend policy models, Modi-Gilani-Miller approach is there, and various other approaches are there. So all of these financial models and economic theories which have been given, so all of them talk about certain assumptions. So the whole of finance and the theories which have developed in finance and economics, they are drawn upon certain assumptions, and one basic assumption all of these theories make, that man is a economic man, man is a rational man, man is he takes decision based on the maximizing his utility. But in actual practice, in real life scenario, none of the decision makers are rational. Many times they are rational, but many of the times they are affected by various biases. So that is what we want to understand, that how the standard finance theories are not being able to deliver us the answers of various questions or of various models which are given by these theories. So just a recap of what are the standard finance theories which we have seen or which have been developed over all these years. Like all of us understand, those who understand or who are the students of investments, they would know that there is a capital asset pricing model, arbitrage pricing theory, efficient market hypothesis, expected utility theory, and these are theories from economics, diminishing marginal utility theory, agency theory, bounded rationality given by Herbert Simon, Modi-Gilani-Miller approach, modern portfolio theory. So all of these standard finance theories or classical finance theories, they would usually talk about that man is rational man, then there is a perfect competition in the market. So only in perfect competitive market where there are large number of buyers, large number of sellers, there are no taxes, information is available freely. So most of these theories are based on these underlying assumptions, and then they are proved true, or then their values can be calculated while making some calculations. Now, how standard finance theories are different from behavioral finance? As we have seen, on various criteria we can identify the difference between the standard finance theories and the behavioral finance theory. One aspect is risk. The standard finance theories considered risk as an objective term, that risk can be quantified, risk can be calculated as beta, risk can be calculated from the standard deviation. But behavioral finance theory says that risk is subjective. One person can have a different level of risk taking capacity as compared to other person, and it cannot be objectively measured. Then with respect to the return also, there is a difference in the two theories. Standard finance assumes that risk and return has a linear relationship. If risk will increase, return will also increase. But in behavioral finance, we say that there is an inverse relationship between perceived risk and perceived return. We are not talking about actual risk and actual return, because it is subjective risk. So the risk is perceived risk and perceived return, and there is an inverse relationship which exists between the two. The behavior of decision maker is rational in case of standard finance theories, but behavioral finance assume that human being is irrational, and he would take all decision based on irrationality. The decisions in standard finance, that the input 2 plus 2 is equal to 4, but that is the theory which we assume that it is a consistent behavior or consistent result which we will get. But in behavioral finance we assume that the decisions will be inconsistent, because there will be attitude of the person or personality of the human being will affect or will intervene while taking decisions. Based on utility theory, again the two theories are very different. Standard finance theories are based on maximizing the utility. So, every person will try to maximize his satisfaction or maximize his utility, whichever he can derive from any decision he is taking. But behavioral finance assumes that people do not try to maximize their utility. They try to satisfy, or they try to reach a level of satisfaction. So, not everybody would like to maximize utility while taking all decisions. Then based on arbitrage also there is a difference. Standard finance assumes that arbitrage is possible. Arbitrage is the process wherein in a free market people buy and sell, or they make transactions without any loss of money or without any risk. But behavioral finance assumes that there is limit to arbitrage theory, which we will discuss later. There are underlying theories which are driving the standard finance, like the EMH theory, and in behavioral finance there is cognitive psychology and limits to arbitrage theory which plays a role. In case of standard finance we assume subjective expected utility theory to play a role, but behavioral finance theories do not follow subjective expected utility. In standard finance, the theories and models say that we can predict the stock market, but behavioral finance say that it is very difficult to predict the stock market. The information dissemination through standard finance, because there is an assumption in standard finance that the information dissemination is equal, but in behavioral finance we assume that everybody has unequal information. Some people have more information, some people have less information, some are more informed, so their decision making is dependent upon that. Now, what is the need of behavioral finance in today's time? After this dot-com bubble which happened in the year 2000, it was realized that there is something which these standard finance theories are not able to identify, and these bubbles and crashes, they happen in the stock market, and the whole economy is affected by going into depression or going into a slowdown, and we say that everything is badly affected. After that, there was a global financial crisis which affected US market in 2007, and it was identified that traditional finance model have failed to predict such type of financial bubbles or crashes or problems which affect the economy. So, there was a need at that time. Many researchers realized, and the governments also realized, that there is something else which we need to understand so that we are able to predict such kind of crashes and problems which the economy faces. So, it was found out that behavioral finance can give the answer to these theories. So, behavioral finance covers individual and group emotions and behavior in the market. So, this is a field which collaborates various subject areas like personality, cognitive psychology, psychiatry, organization behavior, accounting, sociology, economics, anthropology, behavioral economics. And so, combining that, we have come up with a field called behavioral finance. Behavioral finance suggests that the structure of information and characteristics of participants of the market can play an important role in decision making of the investor as well as the overall outcome of the market. The importance of behavioral finance, after identifying that behavioral finance has the capability to identify that why these crashes happen or why economy goes into a depression or why there is a slowdown in the economy. So, behavioral finance was identified as a significant field. Behavioral finance is about making right decisions which are free from biases and error. It helps understand investor behavior better. It helps improve financial capability of individuals, because people can earn better returns if they understand that what are the biases which are affecting their decision making, and they can take better decisions. It helps in designing wealth management strategies. It is very useful for portfolio managers, mutual fund companies, investment consultants who are guiding people to how to invest their money. So, this subject covers individual biases, emotions, group behavior in the market, and it brings together all academic fields of study for the purpose of decision making. So, main difference between standard finance and behavioral finance comes that standard finance says that man is a rational man. In all theories they say that, and behavioral finance assume that man is not rational, man is irrational. Now, what rationality actually is? Let us first understand that. So, Kahneman in his book Thinking Fast and Slow, he explained the only test of rationality is not whether a person's belief and preferences are reasonable, but whether they are internally consistent. A rational person can believe in ghosts so long as all other beliefs are consistent with the existence of ghosts. A rational person can prefer being hated over being loved so long as his preferences are consistent. So, rationality is logical coherence, reasonable or not. Now, who are the major contributors in the area of behavioral finance who have developed this subject? A very important contribution is of Amos Tversky and Daniel Kahneman. Daniel Kahneman got Nobel Prize in 2002 for giving the foundations of behavioral finance by proposing prospect theory. He has published, both of them have published around 200 papers since their collaboration since 1960. So, in 1972 they gave this prospect theory, and later on they have developed a lot of other theories and concepts related to behavioral finance. Another important contributor is Robert Shiller. He got Nobel Prize in 2003. He got this Nobel Prize after he has written his book called Irrational Exuberance, which was published in 2000 and which predicted that there is a IT bubble which is going to crash and the markets are going to be affected. And later on, in his revised edition for the same book Irrational Exuberance in 2005, he talked about the real estate bubble which is going to burst in 2007, and his predictions were true, and he is the one who is using behavioral finance theories to prove all that. So, Robert Shiller is one of the few economists who has foreseen the bursting of dot-com bubble and also the US global financial crisis. He is a professor of economics at Yale University, and he has also written a book on finance and good society, and which is about the benefits of financial innovation. Very recently, government again found out that behavioral finance is going to be very important field of study. So, Richard Thaler is another big contributor. He got Nobel Prize in this area of behavioral finance in 2017 for propounding nudge theory. He also has given mental accounting concept, loss aversion concept in behavioral finance. So, US government has already implementing this nudge theory by as propounded by Richard Thaler, and he works as a professor in University of Chicago Booth School of Business. Now, some definitions of behavioral finance. Seville 2005 says behavioral finance is a study of influence of psychology on the behavior of financial practitioners and subsequent effect on market. I think of behavioral finance as simply open-minded finance given by Thaler in 1993. Salisbury 2004 says behavioral finance, also referred to as behavioral economics, combines economics and psychology to analyze how and why investors make their financial decisions. The field of behavioral finance has a lot of things in common with the field of cognitive psychology and offers a theoretical explanation for sometimes irrational or emotional choices and actions of investors. Behavioral finance revolves around an investor. So, there are definitions which says that it is people in standard finance are rational, whereas people in behavioral finance are normal. Behavioral finance has applications to portfolio management, and behavioral finance also has applications to market inefficiencies and anomalies. It is very much related or has been derived from various other disciplines. So, while talking about behavioral finance concept, you will find that there are traces of psychology, concepts related to sociology, social psychology, finance, behavioral accounting, investing, economics and behavioral economics, which we will be talking about in and using their references in between. Behavioral finance as a subject is classified into two categories. So, there are two types. One is behavioral finance micro and behavioral finance macro. So, behavioral finance micro is basically the study of individual human being, and it revolves around the individual personality and individual behavior and concepts related to that. And behavioral finance macro is the second part, and it relates with the whole economy, the behavior of the whole market, how markets behave, how group behavior of individual investors or individual decision makers or board of directors, how it happens and what are the factors that affect it. All those concepts are being discussed in behavioral finance macro concepts. The classification of behavioral biases, lot of biases have been discussed and defined under the behavioral finance. So, I'll just rush through these so that next time we have detailed discussion on each one of them. Heuristics, overconfidence, mental accounting concepts, framing concept, representativeness bias, conservatism bias, confirmation bias, negativity bias, bandwagon effect, loss aversion bias, endowment bias, sunk cost fallacy, availability bias, ambiguity aversion. There are various management implications of behavioral finance. Behavioral finance is a field which can help comprehend the emotional side of human beings, how they are affected by biases and how they make errors in judgment. Behavioral finance help identify motivation of clients to invest, and one can understand their expectations clearly, and one can give suggestions to others or give advice to others that how they should invest their money based on their personality, based on their attitude of investing. Behavioral finance can help develop trust and confidence in client advisor relationship, and will also not be affected by the ups and downs of the market. Now, various bubbles which have been affecting various countries and the markets and the economies at various time periods. So, all of these bubbles are affected by, because group of people, they behave in a certain manner, suddenly they start buying certain things or they start selling certain things. So, it is a kind of herd mentality that goes on when a bubble is built and when a bubble is burst. So, whenever there is a bubble which is created, so one very common example of a bubble is the tulip mania of 1630. There was a time in Amsterdam where everybody, suddenly tulip flower, which was very, very cheap, and suddenly people started buying tulip. So, a group of people started buying tulip, and the price of any commodity is determined by the demand and supply. So, suddenly when demand of tulips started increasing, so everybody thought that it's going to be a good product and we can sell it at a higher price. So, that is what I am talking about, the tulip, very popular tulip budget, tulip mania of 1630, and suddenly the price of tulip increased to 10 to 100 times, and even the farmers in that area were growing tulips, and later on one day that bubble burst and suddenly there was no takers of tulip, and suddenly the price fall to very low level, and that is what how bubbles burst. So, why bubbles happen? Because there is uncertainty in the market, there is leverage. Leverage means when you are borrowing money and using that money for investment or for buying your assets, and later on you have to pay it back, and then you are not able to pay it back. So, suddenly the supply of those things increase, and greed is an important factor because of which bubbles will take place. Now, this slide will show about various bubbles which have taken place in various countries at various points of time, like exotic tulip bubble happened in 1637, then 1837 there was a bubble related to cotton, then 1893 in United States there was a bubble related to silver, then Panama Canal, United States, there was a bubble in 1907 related to coffee. So, a bubble can be created with respect to any commodity, any currency or anything. And very recent, the internet stocks, there was a bubble created in United States in 2000, which is very popular. And then in 2007, we all know about it. We all were affected by it. It was a bubble related to real estate, subprime crisis, which affected US and which affected all of the countries of the world. And the basic reason why this bubble happened, because there was greed in the market, because people started buying and selling and following each other, because of which these bubbles get created, and because of these bubbles get burst. Thank you very much. For the next session, we'll discuss about various theories on behavioral finance.
With this note, thank you, ma'am. Thank you so very much for giving us this session. Friends, you are requested to be with us as we are back after a short break and would be discussing on the theories of behavioral finance. Till then, keep watching us, be with us. Thank you. Hello friends, welcome back to this session. Friends, as promised, here we are again, and as per what we said, that we are going to talk on more and more on behavioral finance. So dear friends, in this session we are going to talk on theories of behavioral finance, and for the discussion on the topic we have with us in our studios Dr. Divya Verma Ghakar. Dr. Divya Verma Ghakar is Assistant Professor in School of Management Studies, Guru Gobind Singh, Indraprastha University. Dear friends, we know that you might have lots and lots of questions regarding today's lecture. So if you wish to talk to us, if you wish to ask questions regarding the lecture, then do call us to our toll-free number. Our number is 1800110430. I repeat, our number is 1800110430. You are just requested to call in the last 10 minutes of the lecture. Now I would like to welcome our guest, Dr. Divya Verma Ghakar, once again. Hello ma'am, welcome to the session.
Thank you so much. Starting with the second topic on expected utility theory, agency theory and limits to arbitrage. The students of finance and students of economics would very well understand this topic, and we'll try to see this topic from a behavioral finance perspective and see that how these theories of expected utility and arbitrage theory, so they are being criticized by the behavioral economists, and they say that the rational human being is someone who is practically not available in the practical life, and it is more of irrational decision making or the satisfying nature of human being that affects and that governs their decisions. So in this topic we are going to touch upon three theories. First we'll talk about the expected utility theory. Bernoulli gave expected utility theory in 1738. He used a coin toss game known as St. Petersburg paradox to demonstrate the limitation of expected value as a normative decision rule. He proposed utility function to explain people's choice behavior. He assumed that people try to maximize their utility, not expected value. So basically the expected utility theory suggests, it first assumes that the man is rational man, and everybody will try to maximize their utility under the given circumstances. So, in this expected utility theory, he proposed that utility is not a linear function of wealth, but it is a subjective, concave evaluation of outcome. Thus introduced decreasing marginal utility concept. As we consume more and more of a commodity, our level of satisfaction or the amount of satisfaction which we derive from every extra additional unit goes on diminishing. That is what diminishing marginal utility concept talks about. And every human being will try to maximize their utility. That is what expected utility explains. So, it also implicitly assumed the concept of risk aversion. It also assumed that the people's attitude towards risk was posted as byproduct of their attitude towards value. There are 5 axioms of expected utility theory. First one is preference axiom, also known as comparability axiom. If there are 2 players and there are 2 set of lotteries, let's say lottery A and lottery B. So, a participant can prefer lottery A over lottery B, or he is indifferent about both the lotteries, lottery A and lottery B, or he prefers lottery B over lottery A. So, that is what preference axiom is. Second axiom is transitivity axiom. So, this is also known as coherence axiom. It says that if lottery A is preferred to lottery B, which is preferred to lottery C, so indirectly lottery A is preferred to lottery C. Non-saturation axiom. As per this assumption, any person wants to infinitely increase his utility. Continuity axiom. Any minor change in probability of happening should not lead to modification of order of preference of individual. And finally, fifth one is independence axiom. The preference characteristic should not change with any change in number of alternatives available. Like, if third lottery is introduced, the preference of individual towards the first 2 lotteries will not change. What is the significance of expected utility theory? Expected utility theory explains how decisions are made based on coherently weighing outcomes of action by their probability. Those outcomes which give more utility are chosen and thus show preference of dominating alternatives. The expected utility theory deals with analysis of choices among risky projects with possibly multidimensional outcomes. So, it also describes preferences under risk. The way alternatives are presented do not influence their decisions. So, the assumption of expected utility theory hypothesis, we can say, it assumes that individuals are rational while facing uncertain situations. So, every individual has information available which can differ amongst them, and the information may not always be equally available, but everyone will process this information rationally. In game theory and economic decision theory, expected utility hypothesis concerning people preferences with regard to choices that have uncertain outcomes states that if specific axioms are satisfied, the subjective value associated with an individual's gamble is the statistical expectation of individuals' valuation of the outcomes. But expected utility theory has been criticized by the behavioral economists. They argues that Bernoulli's paper was concise and brilliant, but it is not a perfect theory. EUT or expected utility theory is a simplification of reality. It does not guarantee human behavior and practices which are followed in real life. Researchers who have tried to test the adequacy of expected utility theory have found that there are deviations in actual behavior which has led to the development of the subject of behavioral finance. Later on, there is another theory called revealed preference theory. After 2 centuries of introduction of expected utility theory, von Neumann and Morgenstern revolutionized Bernoulli's expected utility theory by giving revealed preference theory or subjective expected theory. Bernoulli used utility to define preferences, while von Neumann used preferences in defining utility. Von Neumann do not define individual preferences orderings, but define certain constraints on possible relationship between individual preferences. The axioms used in revealed preference theory are consistency and coherence. So, people seek to maximize their subjective expected utility. Each person may have a different utility curve, but all follow same normative axioms for achieving their individually defined maximum subjective expected utility. So, there are three axioms for revealed preference theory. One is transitivity, which is explained as that if A is equal to B and B is equal to C, so A is automatically equal to C. Dominance. So, if one option is better in one aspect and good in rest of the aspects, then it would be preferred over others. And third is invariance. So, the preference remain unchanged regardless of order or method of presentation. All these axioms are relevant to all decision making models and are logically correct, but these are being violated by actual human behavior. That is what Kahneman and Tversky in 2002 gave their major findings of prospect theory. Agency theory. Agency theory, even the students of commerce or economics would know about this concept of agency theory, where there is in any organization where we are dealing with contracts, so a human being, so there is a principal and there is an agent. So, when we enter an organization, so we are working on behalf of the owners of the organization. So, they have certain visions, certain objectives, certain goals to accomplish, to be carried out as per the contract which we enter with the organization. And we as employees of those companies or as employee of those organizations or at any level we are working, we are supposed to carry on that roles and responsibilities and the visions and goals which are defined by anybody. So, that is what this principal agent relationship is all about. So, one person in any point of time would be a principal, another one will be an agent. This is applicable to any kind of human relationship which exists. So, if you are working on behalf of somebody, you are an agent of the goals and objectives which are set or the task which is assigned by the principal. Now, where is the mismatch? So, this agency theory talks about a mismatch between the thought process or the decision making which goes in the mind of the principal and the agent. Now, what happens that principal has certain mindset, certain vision, certain rules or objective which is defined. He transfer these to the agent or the employee that you have to do this, this is the target which you have to meet, this is the way how you should work. In between there is a general interest. Now, the agent who has to perform the role on behalf of the principal, and what he is getting in return is the salary or any reward or achievement which he is going to perform. So, what happens that the agent, he is working towards the organization goals and he is also working towards his personal goals. His personal goal can be related to getting good salary, getting some perks and other packages or other achievement of his own personal career related goals. So, sometimes when there is a conflict of interest between an employee's personal goals and the organization goals, as a human behavior, people tend to prefer their personal goals. But under the law of contract, they are not supposed to work for their personal goals, because between the working hours, they are the employee and they are the agent of the principal. They have been assigned some role and they should put the general interest over the personal interest. So, if there is a conflict between this type of decision, or there is a decision which comes where either your personal goals are being affected or your professional goals are being, your organization goals are going to be affected. So, in that case, if somebody fulfills the organizational or puts organization goal more than or above his personal interest, then that is the most ethical behavior one should do. But if there is a conflict in that, then there is agency cost and then there is agency problems which exist. So, this agency theory talks about it. So, agency theory attempts to solve two problems. Conflict between management and owner's interest is created because agency problem consists of separation of ownership and control. An agency problem arising between controlling and non-controlling shareholder. So, there is a principal, there is an agent and there is a task which is given by the principal to the agent, to which In return, there will be some payment which will be made to the agent or some consideration paid to the agent by the principal, and in return the agent has to fulfill the task of the principal. Now, there is a cost of agency relationship. So, let us take an example of a business organization or any organization where may it be an educational institution or any other work environment where there is a task given by the principal or there are job responsibility which are defined by the principal, and the agent has to perform those roles and responsibility, but there has to be some checks and balances. They are known as cost of agency relationship. So, the agency cost occur largely from the principal monitoring activities of agents, which can be viewed in terms of money, resources consumed and time taken. For example, remuneration packages and incentive schemes for directors, they need to be watched. So, that is why there are board of director meetings where these decisions are taken. There are corporate governance norms which define that how the decisions will be taken, and it is ensured that none of the board of directors, they pay themselves a higher amount of salary as compared to what is defined in the rules. Then cost of principal reviewing annual report and cost of management providing such data like committee activity and risk management analysis, and cost of meeting with principal, shareholder and financial analyst. And we can always see that all government departments, all business organization in the finance department, they ensure there are a lot of checks and balances. So, these checks and balances are ensured by way of internal audits, by way of third party audits, when all accounts and all financial statements are audited by the third parties, just to avoid such type of agency conflict which can come into the mind of any CEO, CFO or any person who is preparing those books of accounts, because it is shareholders' money which is being invested in the company, or it is public money which is being utilized by those people who are sitting at various positions in various organizations. So, ultimately it should not be underutilized or misutilized. Now, how the agency problems which if occurs has to be resolved when the shareholder activities and market mechanisms are not enough to monitor a company, some part of regulation is required. So, meetings between the institutional investors and directors, voting rights at the AGM in support of or against resolutions. So, these need to be considered while dealing with the agency problems. An important theory related to behavioral finance is limits to arbitrage. Limits to arbitrage has been derived from the concept of arbitrage pricing theory, which is again being criticized by the behavioral economists, and then they have defined this limits to arbitrage. Limits to arbitrage, very simply, an investment student or a finance student or a commerce student would like to understand it in a way that if there is mispricing in the two markets at any point of time, if price of any commodity or any asset or any investment is different in two markets, what one can do is buy from one market immediately and sell it in another market at the same point of time. In return, he will earn a riskless profit. So, earning a riskless profit where there is a price difference in two different markets, just by buying in one market and selling in another market, if you are able to earn a profit, such a profit will be a riskless profit, and this process is known as arbitrage. So, this arbitrage exists everywhere. It can exist in all type of commodities, it exists in all type of currency markets, it exists for stock markets. So, whenever there is an arbitrage situation which occurs, there will be independent buyers and sellers who will come into play, who have studied this mispricing in the market, and they will buy from the cheaper market and sell it to the costlier market and earn a profit in between. But behavioral finance scientist says that arbitrage is not always possible. Now, the benefit of this arbitrage is that arbitrage brings efficiency in the market, or it brings equilibrium in the market. So, what happens when we study about this perfect competition, or the economic students would also appreciate this, that when we study the perfect competitive markets or we study about the market equilibrium, for any underlying commodity, whenever there is a mispricing of that particular commodity in two different markets, what happens? People will start buying from the market where the price is low and sell it to the market where the price is high, and they will continue doing it till the time the prices in both the markets become the same. So, in a short period of time, the prices can be high or low, or can be different, or it can be mispriced. One commodity can be mispriced in two different markets, but later on in the long run, the price becomes the same. So, arbitrage is very, very important for bringing back the equilibrium in the market. But many of the times it was observed that this equilibrium does not come, especially in terms of stocks and the financial investment avenues which are available. Now, why this happened and why it was happening was being explained by the behavioral scientists, who said that it is not always possible for arbitrage to take place. So, not every human being would like to enter into arbitrage process, because, and then they gave this limits to arbitrage theory. So, there are two founding theories of behavioral finance. One is cognitive psychology theory and second is limits to arbitrage. So, limits to arbitrage is a theory which is used to arbitrage away pricing inefficiencies. This is used by rational traders due to restriction on funds. Limits to arbitrage refers to a market where prices do not match the fundamental value, and it has continued because individuals have refrained from the arbitrage process due to cost and risk factor. So, when people are seeing, or when investor is identifying that the prices are different in two different markets, in one market the same product is available at a cheaper rate, in the another market it is available at a costly rate, still he is not motivated to buy from one market and sell it to other market as per the rational decision making which should happen. So, this is what is limits to arbitrage. Why that person is being refrained or he is not doing it? Because there is cost involved and there is risk involved in real life. So, that is why people restrain from arbitraging away the market mispricing always. So, what are the limitations to arbitrage? Arbitrage is considered riskless without the need of capital. In practice, however, it does require capital and is associated with various forms of risk. Arbitrage needs to be performed by specialized traders who are not well diversified. Assets can further decline in price in short run, even if it is a good bet long term, especially in value situations. Clients do not have perfect knowledge of the arbitrager's competence. It can thus be a rational choice to withdraw capital from an underperforming manager. This forces the manager to sell off assets even though the expected return actually increased after the price drop. An agency problem breaks down the link between greater mispricing and higher expected return from the client's perspective. This can result in irrational prices, while the arbitrager and their client themselves act rationally. Now, the conditions of arbitrage: there should not be a law of one price, meaning that the same asset does not trade in all market at the same price. No two assets with same cash flow should trade at the same price. Asset should not be traded at its present value discounted at risk free if its future price is known, or the asset has significant cost of storage. Who is an arbitrager? He is a person or a player in the market who try to earn a profit from the mispricing of the market by making simultaneously trades and making riskless profit. Arbitrage is of two types: riskless or true arbitrage, where there is no risk involved, and second type is risk arbitrage, where there is some sort of risk involved in playing with the buying and selling in two different markets, and it is again of various types. Now, what are the costs of arbitrage which stops investors to play in the arbitrage or become an arbitrager or to buy and sell from two different markets? There are various types of risk and cost involved. First such type of risk is fundamental risk. Fundamental risk refers to the risk of new bad information arriving to the market after the security has been purchased. Let's say a particular stock is available in two different market, let's say at National Stock Exchange in NSE market and in BSE market, there is one share, let's say of Wipro company, which is being traded at any point of time during the day when an investor is watching it at two different prices. In one market it is cheaper, in another market it is costly. Now, the basic phenomena says that one should buy it in the cheaper market and sell it in the costlier market, in the BSE market, and then in the NSE market he can sell and earn a profit. But what stops him from doing that? There is a fundamental risk involved. It can be possible that the price is lower in the BSE market because there is some negative news which is going to come about that stock which the investor is not aware of and he doesn't want to take the risk. It can happen that as soon as he buy from one particular market, a bad news or some news which is not favorable for him can come, and later on his choice of selling it at the same price or at a higher price and earning a riskless profit does not exist anymore. So that is why it may happen that the fundamental risk factors or the factors which are fundamentally relevant to the company, they can affect a person for not taking such a decision of entering into arbitrage. Then there can be noise trader risk. Noise trader risk refers to the risk that mispricing deteriorates in the short run because there is a possibility that pessimistic traders become even more pessimistic about the future. Noise trader risk is very important because of its link to other agency problems. It can force people such as hedge fund managers and institutional investors to liquidate their positions early, bringing them unnecessary and unwanted steep losses. Noise trader risk can have agency effects and time horizon effect, and mispricing may force arbitrager to liquidate early. Who is a noise trader? Noise trader is a person who is an irrational investor, who doesn't look at any news, or who's a speculator in the market, and who has some information which can be, let's say, very good, or which is related to some secret information of a company, or who deals with the noise which operates in the market. So sometimes these noise traders, they try to affect the mood of the market, or they try to turn the mood of the market or the prices towards an upward or a downward scenario. So they can be pessimistic traders or they can be optimistic. If they come available in a big number, they can turn and they can affect the prices to a great extent in the market. So that is what this point explains, that there is noise trader risk. It may be possible that suddenly you have purchased some stock or investment for playing into arbitrage, and suddenly there is a noise trader risk which comes, or there is a pessimistic lot of investors or an optimistic lot of investors who behave in the opposite way in which you have thought the market will behave, and you have no control over that situation. Third is implementation cost or transaction cost. All the finance theories and even the arbitrage theory assume that there is no transaction cost and there is no implementation cost in the market, but in practical life there is transaction cost involved in every buying and selling, and there is implementation cost involved. So if there is such a cost involved in the process, so these costs can be like bid-ask spread costs, brokerage fee, expense ratio for funds, short sale constraints, and these costs can make arbitrage process very costly, and mispricing may exist, which can be known as limited arbitrage. Fourth type of cost is agency cost or performance requirement. It can be related to the agency problem. You as an investment manager want to take a decision, but the employee who is working under you doesn't want to act in a way in which you want him to act. So there can be agency problem. So fund managers are not the owners of capital, so there can be principal agent problem. Fund managers are investing the money of other people. Sometimes they take decisions that are necessary to maintain the job rather than give optimum returns to the investors. So that is one reason why limits to arbitrage take place in any market. Fifth one is the horizon risk. Horizon risk arises when prices reach to a fair level with so much delay that is beyond the expected horizon and it is not worth it. This risk reduces the actual returns generated when compared with the estimated returns. Thank you very much for paying attention to this session. So basically this session was talking about the expected utility theory, the theories of revealed preference, agency theory and arbitrage theory, and how behavioral scientists at various stages have criticized it and talked about that, you know, there are better solutions to it, and there can be and so various theories of behavioral finance were developed based on it, and like limits to arbitrage, which forms the foundation. Maybe in the next coming sessions we'll talk about prospect theory and various heuristics and biases which can affect the investor decision making. Thank you very much.
With this note, thank you, ma'am. Thank you so very much for giving us this session on behavioral finance. Dear friends, there is a lot more for you. So we request you, as always, that if you have any questions or if you have any queries, you can write to us at info.cec@nic.in, as well as you can post your feedbacks too. Friends, we are going to meet again very soon and would be discussing more. Till then, take care. Goodbye. Thank you, ma'am. Thank you. Thank you.